Welcome into the reaction channel, folks. We got a bunch of things to react to here today in this video, okay? Two stocks that I own reported earnings this morning. We'll go over both of those. Shopify, Revolve, those stocks are making some pretty insane moves. We're going to talk about the market in general in this video here today. Revolve's up 33%, which is a decent sized position for me in the public account. And then Shopify today is up about 18% roughly. So we'll speak about both those stocks. We'll talk about kind of the opportunity there in both those, go over the earnings here at the top of the video, and then we'll talk about just some other like stocks in general in this market, some moves out there. I'm keeping an eye on some stocks that might be the next ones up that I'm buying essentially. Then we're going to go ahead and react to three videos in this one. First one up here, get defensive and take a barbell approach to this market, says Anastasia. So looking forward to reacting to that one. Don't see any reason for the Fed to make an emergency move right now. This particular video is from yesterday. SoFi's Liz Young was talking about that. I thought that was an important subject because now there's a lot of people talking about the Fed should start cutting rates and those sorts of things. So I thought that could be an important subject to discuss. And then the last one up here, we are setting up for an early cycle rotation. I think that's an interesting video to react to. Early cycle rotation, where are we going there? Okay. Appreciate y'all joining me as always. Thank you so much for being here, folks. Thank you for being subscribed. New all-time high. Today, for the pinned comment down there, I'll put, if you're looking to apply to join my private stock group, you're looking to take your training up to a much higher level than where you're at right now, get access to 1000xstocks.com, all those sorts of things. I'll put that as a pinned comment. You can apply to join us in there. And then once you join us, we'll send you over your membership card and your other membership card. We got two different ones. I think the private group's a little cooler than 1000x, but that's just my opinion. So Shopify. Here we go. Shopify's earnings, it was an A-. I graded them at an A- income statement here. Subscription solutions went to 563 mil from 444. We had merchant solutions go to 1.48 billion from 1.25 billion. So total revenue for the quarter was over $2 billion versus a little under 1.7 in the same quarter last year. As far as gross profit went, that went over $1 billion for this quarter versus $835 million in the same quarter last year. Look at their expenses. They dropped R&D. They basically cut it about in half. I mean, that was incredible, right? General administrative, they cut that in actually over half. Like, that's insane, over 50% down year over year. So Shopify's put themselves in a lean position. And the incredible thing about this is Shopify's still growing at 20% plus clips, even with all this cutting of G&A, all this cutting of R&D, right? And sales and marketing wasn't like it went up that much year over year, right? So they're clearly running their business on a high level now. They must have had definitely some bloat in that business, and they kind of did a meta situation here. Total operating expenses came in at 804 million versus 2.4 billion for this company in the previous year, right? If we look at income from and keep in mind a big part of that was that one-off there, that 1.3 billion. Income from operations, 241 mil versus 1.6 billion dollar loss. Now this is important here, net loss or gain on investment, they had a $120 million net loss here. So that kind of hurt profitability. If it wasn't for that, the numbers would have been even much better when it comes to net income. But net income came in at $171 million, came in at a diluted 13 cents a share. These results ended up being pretty far ahead of what a lot of folks were expecting out there on Wall Street. And so really good numbers from Shopify. Shopify, as I told you guys before these earnings, I've been talking about Shopify for weeks now, right? If not months. And this is one of those stocks you just buy and you buy and you buy. Sure, Shopify was a better buy yesterday at $53, right? But at 63, it's still a buy. So it's a really easy stock to just buy, add more and more and more of, and just hold for the next 5 to 10 years. It's not, it's not the most complicated company in the world. They're just a 20% plus grower a year, and they're growing their bottom line at a much faster clip. Now, a little bit of a hidden stock here is Revolve. This stock obviously made a ridiculous move here today, 30% plus, right? But with Revolve, a lot of important things are going on here that are changing this business model. So if we look at revenue, first off, they grew revenue, which is an exciting step in the right direction. Okay, that definitely helped. Cost of sales, they kept that pretty in check. Gross profit went to $152 million versus $147. Revolve's a really small market cap company. So $5 million is definitely a good up on a year-over-year basis for gross profit. Now look at operating expenses. They brought fulfillment down a little bit year over year despite revenue going higher. Additionally, selling and distribution, they actually kept that in check as well. That was down slightly year over year once again, even though revenue was up about $9 million year over year, right? Marketing expense, they brought that down significantly. Look at that, from $51.4 million to $42.9 million. Now keep in mind, even though they brought down marketing so much, they still grew revenue, which is very good, especially in this weak consumer environment with consumer sentiment where it's at. That's so positive. G&A, general administrative, that was the one kind of trouble spot I saw for the company. That was up about $5 million year over year, so I didn't like that. Total operating expenses for the company was down year over year. So here's the deal. If your revenue is going higher, right, but your operating expenses are going lower, you know your profitability is going to explode to the upside. And that's exactly what happened here. Income from operations, $16.4 mil. They had a kind of a benefit here of $4.2 million. So if you look at income before income taxes, $20.7 million. And net income over $15 million. Now it's versus 7.3. So they over 2x their bottom line net income on a year-over-year basis. Phenomenal. Diluted EPS 21 cents versus 10 cents in the same quarter last year. So really good results from Revolve. You know, what got me through Revolve to keep holding the stock, even through some dark days over the past year with how bad consumer sentiment's been? One, the business model. Two, very important, the management team. These two, co-CEOs of this company, they've done a heck of a job. They built this company from a nothing company, obviously, right, into what it is today. Sometimes you just got really good CEOs that they're going to go. All businesses go through a tough time, right? But there's certain CEOs that they can't get the company out of a tough time, and they just get stuck in that tough time for like ever. It seems like, right? Under Armour seems like it's been that type of company. And then you have certain CEOs that are so good that when their companies go through a tough time, they come out of that tough time and they emerge as even a stronger company than when they went in, right? And when I look at Revolve and I think about how bad consumer sentiment's been in e-commerce kind of market and sales for the past year or two, and how much the consumer got hit by inflation, right? I look at a Revolve and I think this company's going to emerge a much stronger company coming out of this as consumer sentiment improves in 25, 26, and in future years, right? As the consumer sentiment comes back, Revolve's going to emerge as a much stronger company than when they went in. And you're going to see that net income, that revenue reach all-time records by far and away, is what I see here. So Revolve, this is another one. It's like, okay, yeah, it was great yesterday at $17, $18, but 23 is still a joke. Like, this company, in my opinion, will go back to new all-time highs. And all-time highs are a long way from here. All-time highs for the stock are in the 80s, okay? That's where I see this company going back to in future years, especially given this earnings report. This made me feel much more confident about that. So Revolve, very exciting stock. Now, in terms of other moves out there here today that kind of caught my attention, we obviously had some weakness again in Bitcoin, Ethereum, right? Which just definitely shows there's we're going back to risk off a little bit here in the short term. If we look at the markets in general, Dow is down 200 plus points here today, S&P 500 down, NASDAQ down pretty big. I think a lot of that SMCI is definitely just kind of like weighing on everything, and that kind of brings down semiconductors in general, and we'll kind of take a look at that from here. Amazon up today, Nike up today, PayPal was around break even. So it wasn't a bad day for me in the market, I can tell you that much. I think I was down like very, let's call it small amount. So I was thankful for that, right? And obviously Revolve and Shopify helped big. If we look at big tech here today, Nvidia was down huge, Tesla down huge, 5% move, 4.4% move there. MU down more, AMD down to 128. AMD's looking pretty darn attractive. AMD's looking pretty darn attractive, folks. Pretty darn attractive. That's one of those I'm looking at, I'm like, ooh, boy, I might want to start a position in that sooner rather than later. That's very attractive. If we look at commodities, so when it comes to commodities here, GSG, not doing a dang thing, not even a chicken wing. And I love that. I love that, man. And the reason I love that is it basically means inflation sleepy. If we go ahead and take a look at e-commerce today, Chewy was down to 22.22. Maybe that's a sign I should buy. Shopify obviously had a great day today, up about 18% there. If we go ahead and take a look at housing stocks here today, a rough one for certain stocks in the housing trade, right? Redfin, Rocket, CCS Communities, Toll Brothers. Some of those had a tough one today. Let's go ahead and take a peek at my potential hedges watch list here. So yeah, coin's getting hit here recently, but that's obviously with the weakness in Bitcoin, right? So semiconductors watch list. Oof, look at that move down for SMCI. See, that's what I told you guys. It's just that stock just weighed everything down, because you get SMCI to make a 20% downward move, and that's going to put weight on Nvidia. That's going to put weight on AMD. It's going to put weight on all the semiconductor stocks, which obviously all those stocks have gone up immensely, right? MU, the memory chip giant's down to 86 now at this point in time. So yeah, man. Whew. Definitely some real weakness out there. Cruisy Doozy was the one to kind of buck the trend, but Cruisy Doozy, they're really just dependent upon what's going on with iPhone sales, and a lot of people are feeling good about next iPhone sales, and so therefore Cruisy Doozy is kind of able to get through that. If we look at the travel watch list here today, Airbnb down big, about 13.3% there. Wynn Resorts is down slightly. I didn't think Wynn Resorts numbers were bad. And let's go ahead and take a peek. By the way, this is inside my private stock group. I have an income statements tab. Just kind of keep everybody up to date with what's going on with these companies. Wynn I had is a B grade income statement here. So total operating revenue is $1.73 billion versus $1.59 billion in the same quarter last year. As far as operating income, $269 million versus $250. Interest expense dropped a bit for the company on a year-over-year basis, which was good to see, but interest income also dropped as well, but interest expense dropped more than interest income dropped. That was about a $10 million drop there versus about a $16 million drop here, so that's good to see. Income before income tax is $154 million versus $132 million. If we look at net income attributable to Wynn Resorts Limited, $111 million versus $105. That's good, because keep in mind they also have their Macau subsidiary, and so the Macau subsidiary gets a portion of the net income overall. Okay, so 111 mil versus 105, diluted EPS 91 cents versus 84 cents. Really happy with those results out of Wynn. From what I hear, the Middle East property that they're building right now is going up rapidly. On the conference call, they said something about it's already at the 15th floor, so it sounds like construction is going very well. I believe they talked about 2027 opening. Who knows? Maybe things go better than expected. Maybe they open in 2026 for that property. So I'm happy with Wynn. Wynn's an easy stock for me to buy. I don't stay awake at night worrying about Wynn stock. That's one of those I can just buy over the next 6 months or so. Recession, no recession, whatever. That's just a great company. They've been through it all. They went through the Rona shutdowns. They went through the Macau crackdown, right? They went through the great financial crisis. This company's been through it all. They've been through it all, and they make it out, and they emerge stronger. And so I see no different. And I think the next 10 years for Wynn is going to be a pretty darn good one. But the next 6 months, that's a little shaky, and that's why I'm looking to buy. Get defensive and take a barbell approach to this market, says Anastasia.
Ahead for your money as the markets make their way through this turbulent week. Let's welcome in Anastasia Amoroso, iCapital's chief investment strategist, with me here at Post 9. It's good to see you. Welcome back. So what are we to make of what's transpired this week?
Well, today, the stocks are struggling to hold on to any gains. And I think, Scott, the reason for that, this is such a low conviction market because we don't seem to have conviction as a market in the economy. And we've got initial jobless claims that are coming up tomorrow. I feel like people are waiting for that with bated breath. And it seems like in the beginning of the week, the recession fears were on. Today in the morning, they were off, but maybe they're back again. So I think that's why we're likely to chop around while we try to sort out the data. You know, the other thing, when you have drops like we've seen on Monday, you look to technicals. And what we know from the technical setup is that this is a very thin liquidity market. You look at the market depth, it's something like 63% below the last 20-day average. So, you know, you got uncertainty, you got bad liquidity, bad depth, bad seasonality. By the way, the S&P is now trading, I think, 52.15, which is below the 3-month average. And none of that is good because that drives systematic selling.
There were some who suggested this was mostly positioning. You know, we had the unwind of the carry trade, and that was Monday's conversation. It's sort of mixed in with the concerns about the economy, which is so interesting because last week, as the Fed chair spoke on Wednesday, he sounded pretty sanguine about where the economy was and where the labor market was. Said it was just normalizing. And we got this jobs report, and everybody kind of had a panic attack over where the economy truly is.
Well, it was the payrolls report on top of the SOM rule that has been so frequently discussed and debated, I would say, and that's what really spooked the markets. And Scott, the market, I mean, going into July, where we're talking about this potential disconnect that's building between the economy and the market expectations, and look, the economic data has been surprising to the downside for quite some time. The labor market has been surprising to the downside, and yet the markets had to catch up with that. So I would argue that maybe some of the unwind has been just positioning driven, but I think we now have a catalyst, which is watching the payrolls data. The reason why markets pay so much attention to payrolls, because that's what the Fed chair essentially created as the new yardstick for the markets to watch, the labor market and what they will do after that.
There's a feeling today, at least in some corners of Wall Street, Tony Pasquarello, Goldman Sachs, for example, saying it's not the start of a new trend. This could be just one report. Don't take your eye off the overall market ball. Now, don't step in with 2 feet, because, as you said, maybe the unsettling feeling of all this has a little bit more room to go. But do you look at the market and you say there's opportunity to be had, or are you just kind of stepping away and letting things settle?
Well, a couple of points here. First of all, I talk about the low conviction in the market, but our conviction is that we're not headed for a recession. And I'm still in the soft landing camp. And I don't think the data that we've been getting is actually recessionary. I mean, one data point that sort of flew under the radar was the one on Monday where the ISM services number, the employment actually increased. That indicator has increased. So that's different than what we've seen in the payrolls report. So that maybe suggests that the payroll miss that we've seen is a one-off. We do know immigration contributed to the unemployment rate. We know that the new entrants in the labor force drove it higher. So, and then of course you look at the Atlanta Fed GDP, we're looking at 2.9% for this quarter. So I'm still in the soft landing camp. And so that brings me to the second point, which is I do think there are opportunities to be had in this market. I don't think it's a quick snapback, because we're going to be...
It's really tough for me, guys. So what's really tough is when I look out there at the economy, I kind of look at what's going on around me, right? I live in Las Vegas, if you didn't know. So what do I see when I go out there to the real world in Las Vegas? I see construction everywhere. It seems like every other street and highway is getting worked on, and I see all these construction workers all over the place. I see homes being built all over the place and just massive amount of jobs being created with that. I see my neighbors getting, including myself, getting projects done on their front yards, their backyards, and all the workers that go into that, right? If I go down the strip, it's insanely busy. And you look at Wynn Resorts numbers out of Las Vegas, very good numbers. You look at the other companies, like good numbers out of Vegas, right? Everything's busy down there. So maybe I live in a bubble because I live in Las Vegas, right? And it's just like, man, there's construction everywhere. There's construction workers everywhere. There's home building everywhere. The strip's doing just fine. But in the real world, I'm just not seeing any data points right now that make me say, oh, recession. If I go out to North Italia, or if I go to Flower Child, or if I go to Cheesecake Factory, it's freaking packed. If I try to go to Texas Roadhouse, it's always a big wait time. Even if I go non-peak hours, it's still a big wait time. And so if I go out to eat, it's so dang busy. If I drive around, there's construction workers everywhere. There's home buildings, homes being built all over the place. It's just really hard to like get a feeling of like, oh yeah, we're in the recession, or like going into the recession, those sorts of things, right? When I look at once I look at some of these companies' numbers, it looks more recessionary, right? Especially a lot of these companies that do business internationally, like a Starbucks, for instance, or even the McDonald's numbers and some of these other big global corporations. It's like, oh boy. So that's a hard thing for me, because I look out there in my city and I'm like, looks freaking great, man. Looks like an all-time economy. And then I look out there past that and I'm like, ooh, there's struggles in other places, right? So I think the problem with Vegas is it's basically, it might be kind of turning into like what LA used to be in the heyday of LA, not the LA of nowadays, right? Which is kind of unfortunately a city on decline. Like there was the heyday of LA back in the day when it was like its own bubble, and it was just like the rich and famous lived there, and it was so much success, and it was just like it was its own island away from the rest of the world, right? And I almost feel like Las Vegas is starting to get to that sort of place, and so it just doesn't give me a good reality check on what's going on, right? Look at home prices in Vegas. Like even the guy, Reventure Consulting, what is his name, Nick over there? He's always like talks about like, I can't figure out like all these markets are decreasing, but yet Vegas prices won't come down in terms of the homes. And I'm like, yeah, I wish they would come down because I would love to buy a couple rental properties out here in Vegas, but they just don't come down. And there's just so many people with so many money. I mean, I went to a new development that they're building with my neighbor. That was where did we go this past weekend, right? And they were talking about like overwhelming amount. Like they're talking about they're not even going to likely open the model homes because there's no reason to even open the model homes. There's such an insane amount of demand. And they weren't BSing because I looked at how many lots they sold and they're just selling out everything. Everything they put up is just selling. While we were there, the amount of foot traffic was startling. And that's with interest rates up here. And so then, my neighbor, he started asking a million questions. He asked, what about, what did he ask? He asked so many questions. So one of them was, well, are people buying on loans? And she's like, no. These people are buying cash, right? And so, I don't know, man, it's really difficult when you kind of feel like you live in a bubble city that's just like its own island away from everything. It's hard to feel like really that downbeat about the economy, right?
To build conviction in the economy, but I do think you start to step in and you buy certain pockets of the market.
Yeah, but you're looking kind of defensive, right? Utilities, munis.
That's part of it. And, I think Tony talks about it in his note, sort of looking in both directions. And I think that's exactly what I'm doing as well. I am looking to defensives and like utilities, because if this economy is slowing, not even if it's going into the recession, if the economy is slowing, you want to be looking to defensive sectors. If the Fed is cutting interest rates, historically, it's the defensives that actually outperformed in the 3 months after that. So that's why that has to be part of the barbell. But Scott, I've also been tempted this week by semiconductors because the valuations are now not quite to the lows that we've seen over the past year, but getting pretty close.
Alrighty, next one up here. Don't see any reason for the Fed to make an emergency cut right now, says Liz
Opening bell on
Young.
Wall Street.
And keep in mind, Liz Young's definitely kind of been more toward the bearish side, I would say, over the past few years. I've reacted to several of her videos, times she'd go on CNBC over the past few years. She definitely, I would say, is more on the bearish camp over the past couple years, in my personal opinion. And then, there's a lot of people trying to make a justification that the Fed should be doing emergency rate cuts. And I think it really happened with that day where the Dow went down over 1,000 points, right? The NASDAQ was down big. The Nikkei was down the most since 1987. Everybody started to flip out and they're like, oh my gosh, the Fed's got to cut. And that's just, kind of the reliance on the Fed where things go south and all of a sudden immediately people are like, cut to nothing.
Now is Liz Young Thomas, head of investment strategy at SoFi. Good morning to you.
Good morning.
Heck of a day yesterday.
Sure was.
We'll see whether today is a heck of a day too. What are you seeing? What are you thinking? And by the way, how's the service working? Because some other folks were actually really having some problems.
There were a lot of problems yesterday, but which happens on days when you have a lot of activity that nobody's prepared for. So what I would say,
we got to fix that at some point.
Yes. As far as I know, we didn't have any problems. But what I would say about yesterday is it's difficult in this kind of period because there's so much uncertainty. So you have to focus on what do you know. What we know is that in the short term, markets tend to overshoot, both on the up and the down. So what's looking like is happening today is that we overshot yesterday on the down. Usually that gets exacerbated by algos. Probably some of that happened. We had a lot of unwinding that was going on. But the other thing I would say is that something that I feel pretty certain about is you don't have events like yesterday or even that 3-day period that culminated into yesterday and just dust yourself off and pretend.
That's a great point, by the way. Certainly markets do overshoot. That's very often what happens, especially in downward market. It goes way too far to one side.
Never happened. Nothing's been resolved yet. We still have issues with the yen. I don't think that's over. We still have economic uncertainty. I don't think that's over. It's going to be a long time until we hear from the Fed in a scheduled way. If we hear from them before, I think that would be good. But I don't see there being any real reason for an emergency move from them right now.
How do you think about these 7 stocks that basically make up the majority of what you see in the S&P? And I'm thinking, by the way, of NVIDIA, and I'm thinking of Apple and Amazon and everybody else.
So coming into this, first of all, the other thing to remember is although days like yesterday can feel really scary, the headlines are very scary, right? Japan went from 0 to bear market in 3 days. The VIX at 65. All of that very terrifying. The swings that we saw in the Treasury market that shouldn't happen. But coming into this, it was from a really high level.
Yep.
And right now we're really only down, 8% in the S&P. That's nothing compared to a normal correction. So we still have room to go. And that high level was achieved by mostly those 7 stocks. So when you hit the skids and you hit volatility, a lot of the stuff that has most of the gains and is the most liquid is the easiest to sell. It's the first to go. So it feels the most pain on the downside, which is what we're seeing right now. But I think that's okay too, because we needed a little bit of a right sizing in what's driving the market.
You want to weigh in on this crypto debate we've been having on this day?
What's the debate?
Well, the debate was that it's completely not correlated to anything at this point. Or maybe it's correlated exactly to the NASDAQ.
I think in this environment, it has been correlated to the NASDAQ because it's trading like a risk asset.
Are you kidding me? This is a debate? I've been telling you guys for 100 years. Bitcoin's a play on the NASDAQ. Like, it's a call option on the NASDAQ. If the NASDAQ's going to do great, Bitcoin's going to do even better. If the NASDAQ's going to do bad, Bitcoin's going to do even worse. It's a call option on the NASDAQ. Just facts. Like, there's no debating that. Like, why would that even be a debate? Just look at the price performance and the correlation over time. When the NASDAQ's doing tremendous, Bitcoin's doing tremendous and even better, right? When the NASDAQ's getting destroyed, it's getting destroyed even worse. Perfect example is 2022, right? Look what happened. I mean, NASDAQ went down, 37, 38% peak to trough. Bitcoin went down something like, I think it was 7-8%, if not more than that, peak to trough. Like, that is not even a debate. Like, come on, man.
Right.
The speculation has been, okay, if this Japanese yen thing continues, crypto will come in and save us because it will be uncorrelated to currency volatility. That's possible, but I think the rise that we saw early in 2024 has already been that piece. So, I mean, this yen thing is not new. This has been going on for a while.
But I think the question is every time there's something terrible happens in the world, in the markets, someone tries to assassinate the former president, what happens? Gold goes up, and Bitcoin acts as if it's NVIDIA.
So, and this is my speculation, my opinion. I don't have necessarily proof of this. I would suspect that many of the investors who are heavy in crypto, there's an overlap with the investors who are heavy in tech, heavy in headline makers. And when everybody in that basket gets nervous, you have indiscriminate sell.
She's 100% accurate in that. If you're more of a growth-oriented investor, right, you like to go after a little more risk on assets. Yes, if you're gonna, I'm just gonna tell you, if you own Bitcoin, there's a much higher probability you would also own a stock like an NVIDIA or an SMCI or some of these sorts of positions, right? Yeah, that makes sense, 100%.
And you see all of the risk assets in that basket go down. I think that's what's happening right now. That's what happened yesterday and what's been building for the last week or so.
What are you smiling about?
I mean, gold's basically where it was 10, 15 years ago. And
that's so true
it goes up $30 as a flat.
It doesn't go down. Store of value.
Bitcoin was 4,000.
Store of value.
Bitcoin was 4,000 and went up to 75,000. When it goes to 50.
But to be fair, what have we been in for the last 10 to 15 years? A massive risk on market, right? We've been in a massive risk on market since 2009. Like, let that sink in for a moment. We've had short-term periods of volatility where the market goes down, but ultimately, where have we been since 2009? Up and away. And so in a risk-on environment for 15 years, gold's not going to likely do that well, right? That's why you don't see me investing in it. But you know what will do well in a risk-on environment for 15 years? Something like Bitcoin, right? So, yeah.
Who don't like Bitcoin? Took a victory lap when it fell back down to 17,000. Then it went back to 73 again. It falls to 50 and they take another victory lap. If it keeps doing this, if it keeps being the best performing asset for 1 year, 5 year, 10 years, and 15 years, sooner or later the store of value arguments is just not going to.
I sort of agree with that, but you have to assume that everybody's going to sit in it for 5 years, 10 years, 15 years.
They have been so far, though.
I don't think many of those investors do. I don't think that they.
You don't know about hodlers?
I know very well about hodlers, but because of the volatility that we see, that tells me that people don't stick around entirely. And if it is a store of value, you don't want to see that kind of volatility in an asset class that's expected to be a store of value.
But I don't know any. Do you think stocks are a store of value?
Liz Young's too serious to deal with Joe. She's too serious to deal with Joe. She's like,
No, not. No.
Yeah, I don't either.
I think they're
because they can
prone to volatility.
They can go from 2 to 100,
but they do something.
Well, then you change the rules of the game again, because there are people that think that Bitcoin does something too. What would it take for you to finally say, "Wow"?
We call that crazy people. I'm just kidding. No, I'm being actually dead serious. We call them crazy people.
Amazing.
Doesn't do a damn thing.
I don't know.
I hope it's not too late.
The day you tell me you love me.
Okay, so that was entertaining to say the least, but I don't think I have anything else to add there in regards to that whole situation. All right, next one up here, we're setting up for an early cycle rotation.
It spiked earlier this week. Joining us now with his view on the market sell-off, what comes next, Scott Chronert, head of U.S. equity strategy at Citi Research. What were you thinking when it got above, how high did it get, Scott? Do you see it that day? It was well above 50, wasn't it?
It got well above 50, yeah, Joe. I mean, I'd say obviously it's a shock because we've been living in this.
We'll see what happens with Bitcoin moving forward. The issue here for Bitcoin, right, is, you take this baby back to many years ago. So this is over 3 years ago now, right? Over 3 years, and Bitcoin's down 5% in the past over 3 years, right? And so, if you go back to here, we're down big. You could take the NASDAQ from any point, right, in the past several years, and it's going to be up. So that's the difference, right? And that's kind of a little worrisome for Bitcoin, I will say that. The fact that you could take the NASDAQ from any point and it's up, right? So same exact point. Let's take the Qs here and see where we're at. So you see here over that time, the NASDAQ's up about 38%. Bitcoin's actually down over that amount of time, right? That's troublesome. That's a little troublesome, I will say that. And the other reason that's more troublesome is even during this time period, you had Wall Street money come in, right? You had the huge excitement that's happened over the past 6 months, which is, Wall Street's going to be able to buy in now. And even despite that, it's still not performing well. So, yeah, interesting. So anyways, that's we'll see how Bitcoin performs moving forward now that Wall Street controls it, right? And we'll just see. We'll see how it goes. All right, let's get into this one.
VIX regime for quite some time now, but heck, going back in our ETF work over the years, I think there's been a strong, group of traders out there that when they see these volatility spikes, there's a natural proclivity to want to sell into it because the roll feature that comes with the ETFs on the VIX usually means that there's a better odds that
where the VIX end up finishing out at today? I actually didn't get to see that. And right now, I think we should keep an eye on two things. One is the VIX. We should all keep an eye on the VIX and what's going on there. Where's VIX at? There it is. 27 finishing out. The other thing we should all keep an eye on right now is right here. PC, put to call ratio. This is a good one to keep an eye on. Let me get rid of the NASDAQ here. So, this is a great one here. I got a note. Below 0.75 means that people are not really looking for puts. Above 1 means investors are bearish. I like my little notes I have here. I didn't know TradingView kept track of all these notes. So anyways, this is something to keep an eye on. A couple days ago, we were at 1.05 on this one. So it was pretty darn high. And just keep in mind, if we get another big bunch of volatility in the next couple days, which is a potential, you'll see the VIX pop again huge, and you'll see that put to call ratio go up to maybe a 1.1, 1.2, maybe 1.3, but 1.1, 1.2 is probably a little more realistic.
The VIX won't usually persist.
Do you think at this point the highs have been seen on the VIX? I guess that's the same as saying, do you think that the panic that we saw on Monday was that just a one-off, or was it the start of something that could lead maybe to us thinking that maybe the soft landing narrative is suspect?
Well, I think you touched on the key point. I'm not in position to comment on where the VIX is going from here, but these spikes usually are not long lasting. But what I would say in terms of what's transpired, been a lot of discussion around carry trade. There's been a lot of discussion around degrossing. All of this probably feeds into the same narrative that many investors were kind of caught positioned down the path that got upended on three fronts. You lost some of your AI conviction with the NVIDIA news. You've lost some of your soft landing conviction as we're looking at the more recent economic data pointing to higher conviction of a Fed pivot. And then on the election side, there was a very strong view that, you had a pro-business Trump lead that now has been erased. So all three of the forces that in our view had been supporting the market as we were at or near recent highs have had some doubt brought into play, and that's quickly been reflected to a point where, we think we're more confident that we're getting close to having priced a lot of that concern in.
Do you think at this point, looking at technical data that we're seeing, Scott, is the lag effect of all the things that the Fed did, is there more to come? Have they been too restrictive? Have they stayed too long in your view? I know that's maybe not what you normally comment on, but are you worried about that?
Yeah, look, my view has been that the Fed loses the narrative, and that's my been concern is that you hold an aggressive hawkish stance too long. You don't allow for the fact that economic data, as it's reported, will tend to be lagging the underlying fundamental circumstance. And you wake up and you find that economic activity has been, in a decelerating mode, and now you have to go into overdrive and attempt to pull it out, right, with a more aggressive response, which is now what's happening, right? So the good news, if you will, is that we're now talking about here at Citi, 2 back-to-back 50 basis point cuts, September and November, then another 25 in December. So you're looking at a more aggressive response. Now I have to navigate what all this means for earnings via, economic sensitivity. And I got to tell you, Joe, our view has been pretty consistent here that we think you have to be clear on differentiating the S&P 500, i.e. that definition of Wall Street, from the broader economy in Main Street, where the S&P 5 is beaten to a different drummer fundamentally. So our earnings resilience call that we've been on for some time now doesn't change. I think what has changed is the positioning setup that on those three fronts that I mentioned have been sort of upended here. The pullback that we've had has alleviated a lot of the concern in terms of too aggressive growth expectations being priced in. So, yeah, we're now back to a point where I think we're looking at a more reasonable setup. Whether we're at the very end of this, very hard to say. As you go into periods of transition from Fed hawkish to Fed dovish or less restrictive, the volatility pickup usually is notable during those time frames. Economic activity does tend to kind of come in, and fundamentals can be under pressure. So even though we're getting closer to a more aggressive Fed pivot, doesn't mean coast is clear, but it sure means that we're setting up for a more traditional early cycle rotation.
Yeah, so my opinion is the Fed should lower interest rates a quarter point every month for the remainder of the year, starting in September. So lower a quarter point in September, October, November, December. So it'd take you down 100 basis points by end of year, right? Assuming CPI stays fine. And then, or there's another option. I would do probably 50 basis points, which is basically just a fancy way of saying 0.5% in September, and then do another one maybe in November. And so you still get to your 100 basis point cut by the end of the year, essentially. So I would do either one of those, and then then we can talk 2025 when we get to 2025 and what we want to do there. But that's what I would do for the remainder of this year, and cut us about 100 basis points before the end of the year. So that's my personal opinion. All right, guys, appreciate you joining me as always. Thank you so much for being here. If you're looking to take your game up to a much higher level in the stock market, you need high level training, apply to join my private group. That will be the pinned comment down there. You also can get access to 1000xstocks.com, which is the highest end service you can get out there in the marketplace. Much love and have a great day.